Welcome back to Finder Investors. I'm Kylie and I'm going to explain how to set down on the path to retiring early. I'll be taking you through how much you need to retire early, how to actually do it, and what specific actions you should be taking in your 20s, 30s, and 40s. If you're new to the channel, please give this video a thumbs up, subscribe, and comment in the sections below. It really does help. Sitting on a beach with a cocktail in hand, traveling the world, or moving countries entirely. These are some of the scenarios that you might be dreaming of in retirement. Okay, but how do you get there if you want to retire early, say in your 40s, 50s, or even 30s? And is it possible to quit working for the man and live your best life while you're still young-ish? Let's break down how you can work it out. Step number 1, calculate how much you need. One trick is to use the 4% rule. This says that you can withdraw 4% of your retirement portfolio each year to maintain a comfortable life. The reasoning behind this is that assuming a diversified portfolio of shares and other assets, you should be able to grow your wealth by 7% per year. From this, we subtract inflation of about 3% per year, which moves your real rate of return to around 4%. If you withdraw more than what your portfolio is returning, your portfolio will get smaller each year. So to work out how much you need to retire, you just need to work out what that 4% is for you. So every $100,000 you have saved, you'll get an income of $4,000 to live off. So that all sounds simple enough, but there are a few factors you'll want to take into account. Number 1, how much do you need to live off? What sort of lifestyle do you want? Comfortable or modest? Do you want to live at home, or do you want to travel the world and take luxury vacations all the time? 2 is inflation. Remember that prices go up due to inflation over time. This means if you're currently 20, looking ahead to retirement, you'll need a lot more money than you think. So while it's critical to know how much we need to retire, what is more important is knowing your figures on exactly how to get there. Retiring early is really a story about simple equations and long-term discipline. To put it simply, set a goal of what you need and then work backwards to see what numbers you'll need to make this a reality. A compound interest calculator is a great tool for working this out. Compound interest is when you add any interest earned back into the original balance. As a result, you have a bigger balance than before, and in the future, you'll earn even more and more over time. It also allows you to calculate your retirement savings into the future and see just how much your anticipated rate of return, time horizon, and regular additions will impact your end result. So let's assume this retire early age we have in mind is 50. Less than 1% of Americans retire before 50, so let's start there. Let's go through a couple of examples. So say you're 40 years old and you want to retire at 50. So you've worked out your minimal retirement living costs will be around $40K per year. So you'd need $1 million in retirement savings. That's 4% of $1 million. Using our compound interest calculator, we can see that you'd need to save $75,000 per year for 10 years. Compounded annually at 7%, this would get you to $1 million. So even if you were on a relatively high income, say $100,000 a year, this would leave just $25,000 to live off in the lead up to retirement. And depending on where you live, taxes may make this even more of a challenge for you. In this case, roughly $75,000 is your savings contribution and $250,000 is the growth from the compounding effect. We've assumed a pretty extreme example in this case, someone starting to save when they're 40. But how about if you started when you were 20? So let's say you were 20 and wanted to retire at 50. So as with the previous example, your retirement living costs are $40,000 per year. So you'd still need $1 million in retirement savings. Using our compound interest calculator, you'd need to set aside around $11,000 per year at 7% growth to reach that $1 million. So in this case, roughly $300,000 is your contribution and $700,000 is the growth from the compounding effect. So the 20-year-old clearly wins out here in a big way. Not only is the savings burden more manageable over time, you'll also need to contribute less than half the amount of cash that the 40-year-old did to reach that $1 million goal. Bearing in mind that if you've saved up $1 million at 4% return, that's $40K a year to live off. So it might not be all that much, depending on where you live. So you know how much you need to retire and how to forecast these figures, but what about the practical steps to make this early retirement a reality? To do this, let's look at how you should be investing in your 20s, 30s, and 40s in order to retire early. In your 20s, you should be starting the compounding effect as early as possible. Market tracking index funds are a great option for young people. You should also be taking on more risk. For most people in their 20s, it's typically more appropriate to take on a higher degree of risk than someone nearing retirement. In other words, more shares, less cash and bonds. Why? Well, when you're young, you're typically investing money you can afford to lose. With a long-term time horizon, volatility shouldn't be an issue for you. You have a whole life of earning potential ahead of you should you make any losses. Get your head around retirement. Research and put together a plan. The earlier you start, the easier it will be. In your 30s. In your 30s, you still have a pretty high risk tolerance, but it probably will be a bit lower than when you are in your 20s. Typically, this is when your salary starts to rise, but so do your costs. You might have a mortgage or you might have kids. So this period is about consolidating and growing your income and retirement portfolio in a way that wasn't necessarily possible in your 20s. You might even be able to take on some debt to finance your investments, such as a home loan. It's time to start reducing costs where you can and upping your contributions to your retirement portfolio, but still staying pretty bullish. In your 40s. If you're thinking of retiring when you're 50, then your 40s will probably be the peak of your earning career. This could be a good time to live as frugally as possible to maximize the final decade of your contributions to your retirement. You may also want to begin dialing down the amount of risk you take on in your retirement portfolio by increasing the amount of cash and bonds you hold rather than shares or other risky assets. This is because shares, for example, are volatile. They rise and fall year on year. During the GFC, shares fell more than 50% and they kept falling for over a year. And it took many years for the stock markets to completely recover. So if your portfolio was 100% stocks just before the market crashed, you'd potentially need to wait years before your portfolio fully recovered, let alone started to profit again. By diversifying into less risky assets in your final years before retirement, you're minimizing that risk. Okay, so let me sum up the key points. Number 1, calculate how much you'll need using the 4% rule. Number 2, know your numbers on how much you'll need to invest to get to your goal. Number 3, your approach should change throughout your 20s, 30s, and 40s. Number 4, start early because compound interest is critical. Ultimately, there isn't a one-size-fits-all approach. You'll need to tailor your retirement approach to suit your goals and the variables in your life. So that's it for now. I'd be keen to hear any questions you might have in the comments below. What are your thoughts on retiring early, and do you have any insights on how you're planning on getting there? And most importantly, what are you going to do once you retire? If you've gotten something out of this video, please hit the like button and subscribe to stay in the loop for more content that's on the way. Would love to hear from you. Thanks for watching. We'll see you in the next video.